Ruth, I love this question. Ruth, you've just sent this question through about 20 minutes ago, and we've just grabbed it and dropped it in here. So good on you for getting what the question is. Ruth, you're saying, just started out. I'd like to know your thoughts on the weight associated with differing factors in property being considered, i.e. length of lease versus expected return versus capital gain. Okay, let's just answer one thing at a time. Okay, so Ruth, length of lease, absolutely. We like the longer lease you can have on a property, the better the value. Also, very depending on how long their tenant's been there and how long they are prepared to sign up for. Okay, the expected return would be very much dependent on what the going rate is. Now, let me give you an example. A property in the middle of Sydney would probably be at a capitalization rate of about 5.5. If it is an ASX listed property, that property is probably going to be closer to about 5% yield, net yield, which means that you're going to pay a lot more for it, okay? Versus a property that's a little bit more regional. So if you're looking at a property that is more regional, you're going to get a higher yield, but your risk level is going to be higher, okay? So take Sydney versus, so Sydney is metro, so you're paying more, and the reason for that is because you've got more people there, and the chances of you filling that property should it go vacant are a lot higher than if you're buying a property in a regional area, let's say of 30,000 or 50,000 people, where if that property goes vacant, it's going to take you maybe 12 months to refill that property, okay? So that is very dependent on what type of property it is and what kind of return you can expect. Now, in one of the previous recordings or Q&As that I did a session of what you can expect in what areas. So have a look through, see if you can find that one. I think it was probably about 2 weeks back that I did what you can expect in what areas, what types of returns. Also, you've asked me about capital gains. Now, this is a very interesting question, Ruth, and thank you for asking. Your capital gain, so you've got capital gain and you've got market gain, okay? Your capital gain in commercial real estate is going to be what are you adding that your tenant is prepared to pay extra for. So let's say, for instance, you're adding parking and the tenant didn't previously have parking. Now suddenly you've found parking space or something and you can add $30 a month. That $30 a month is going to add to the value of your property exponentially, all right? Or if you're adding storage and you can rent out additional storage, that is going to be a capital gain. So you can add that in, you can charge more for it, and that is going to help you get a better valuation on your property. Now, the difference between your capital gain and your market gain is that your market gain is going to move at the same rate as what the area is moving at. So in other words, the higher the vacancy, the lower your market rate, and it works exactly the same as residential. So in residential, if you are in areas where there's high demand, low vacancy, your property is in demand, so it's going to go up, right? So exactly the same as commercial. You wanting to be finding properties that are in high demand areas where there is very little stock. So there's a lot of demand on where there's stock. Now be careful with that, because if there's a lot of development that's happening around, you need to have a look at that. How long are those developments going to take? If it is 3-4 years, then it means that your property is probably going to balance out. However, if you're buying it in areas where there's market growth that's been setting for the next 10 years, then you should be fairly safe. So, Ruth, hope that is answering your question over there. You've made a comment, living outside of Queensland, I've only just become aware of flood and non-flood areas. Right. Assuming more risk in flood-prone areas, hell yes, we'll come to it. How much cheaper should you be buying a property located in a flood area? Great. Okay. So, Ruth, the biggest thing about buying property in a flood area is your insurance. Okay, so the first thing you want to have a look at is, will the insurers insure this property? Now, depending on the type of property, depending on what the property is structured out of, if it is tilt slab, concrete, without anything that can get damaged to a certain height, 9 times out of 10, you will get insurance on it, depending on how high that flood is going and where the location is and the type of structure. If it is a ground level, let's call it a retail property, or ground level office, or ground level even industrial, that is maybe metal sheds with offices and that downstairs, the likelihood is you're going to battle to get insurance. So if you're buying a property in a flood prone area, first thing you want to go and look at is the insurance, and are you prepared to take that risk? That's the first thing. The second thing is your tenants. The type of tenants that you're going to get into that property, they're probably going to check it out and say, this is flood zone. What is their risk? Are they prepared to go into a flood prone area? Because their insurance is now going to be sky high as well. All right. So they're going to be paying a premium for going into your property, which means that your rental is always going to be subject to whatever that risk is. So if you're buying in a flood prone area, you should be paying substantially less. And bearing in mind, reason for that is because your rental is going to be substantially less. So just bear it in mind, do your homework, red flags, due diligence. I'm not saying don't buy in flood zone areas. However, I wouldn't recommend that you buy anything that's above 0.5 meter. You don't want to go any higher than that. It becomes an electrical problem, especially if you've got electrical appliances or electrical plugs at that level or below that level. And really, you're looking at huge costs for replacements. So just bear that in mind. Thank you for sending your questions in, Ruth.